Welcome. Today we have Mike Ware with us to discuss lender liability. Mike has a deep background in commercial lending and credit risk management. In addition to his consulting work in credit risk management and training, Mike is the loan portfolio management section leader and faculty member at the Graduate School of Banking. Mike, thank you for taking time today to discuss lender liability. Maybe you could start us off by discussing what gives rise to lender liability.
It can come from any direction, Larry. Lender liability has basically sources in three buckets of law. One would be common law, second contract law, and the third state or federal statutes. And they can come from any direction, from, of course, borrowers and guarantors, but also governmental agencies, bankruptcy trustees, loan participants, and unsecured junior creditors. We're surrounded, and in difficult times, those lawsuits do percolate up quite a bit.
Great. Yeah, I do get the picture that we are surrounded. The exposures are kind of coming at you from all around. Are there any critical warning signs that lenders should be monitoring, paying attention to?
Absolutely. I got 5 of them. First, helping run the business. Making managerial decisions or helping make managerial decisions. It's where we cross that line into lender liability area. Sudden moves, turnaround, nobody likes surprises, and sometimes borrowers, when they get surprised, they go to their attorney. Dishonesty, obviously, is one. Being arrogant, overbearing. I try to tell people, just follow the golden rule. How would you like to be treated in difficult financial times? Right. And the last is just the lack of experience in workouts. We've had, over a decade of a very solid economy. So we're losing expertise in workouts very quickly. So that lack of expertise can actually expose you to lender liability.
Great. Thank you. So given these exposures, what should lenders be doing to identify and manage and prepare for lender liability?
Well, just a few things. One is to not be deemed in control of your borrower. In a bankruptcy, your preference period elongates from 90 days to 360 days. And it would be a bad day if you have to claw back and give the bankruptcy trustee a year's worth of payments. Some of the things that expose a banker or banker to this situation of concern of in control is exercising rights normally reserved for management, such as which vendor to pay when money gets tight, when to pay payroll, how to pay payroll, things like that. When we exercise our rights of set-off in a collection, did we give adequate warning? Did we give adequate default time and cure provisions and the like? Are deposited funds actually belonging to our borrower? And lastly, are they potentially held in trust for a third party, such as tenant deposits and money set aside for withholding taxes? So it gets more complex, and in control is one of the more damaging aspects of lender liability.
Great. Thank you. That's fantastic. Mike, thanks for sharing your insights today on lender liability. Appreciate everybody joining us today. To learn more about lender liability or the Graduate School of Banking, please see the links in Mike's bio. Thank you.